Today we're here to talk about Social Security. I'm sure you've seen Social Security in the headlines recently. We learned about how Social Security benefits are expected to receive a larger than normal increase in 2022. It is now projected that benefits could increase as much as 6.1%, and that would be the most significant increase since 1983. But we've also heard some concerning headlines about how the Social Security Trust Fund could run out of money, really due to some of the ramifications from COVID. So to address some of our questions and concerns, please welcome Kurt Czarnowski. He is the principal of Czarnowski Consulting. Kurt started working for the Social Security Administration in 1976 and was the former regional communications director from December 1991 until his retirement at the age of 2010. So in this role, Kurt was responsible for coordinating the Social Security Administration's public affairs and public information activities in New England. So he was a frequent speaker at local and regional events for members of the public. So presenting about Social Security in his retirement was definitely a natural transition for him. I'm very excited to have him here with us today. He will present for about a half an hour, and then we'll field some questions at the end. So please be sure to write down anything that comes to mind. Kurt, you want to take it from here?
Thank you, Sarin. Good evening, everyone. Great to be here. Yeah, Sarin said, my name is Kurt Czarnowski. I'm currently the principal in Czarnowski Consulting. Now, for those one or two in the webinar not intimately familiar with us, always proud to say we're an international consulting firm whose world headquarters conveniently located here in a spare bedroom of my house in Norfolk, Massachusetts, which is where I'm coming to you from this evening. But don't worry, at Czarnowski Consulting, our tagline is we provide expert answers to your Social Security questions. Why can I say that? Well, simple. The Sarin reference. I worked for the Social Security Administration for 34 years. The last 19 years of my career, I was the communications director here in New England, which meant I spent my time, as our Canadian friends would say, oot and a boot, talking to people about the Social Security program. And in my retirement, such as it is, I'm actually in my 11th year of continuing to do that same type of work, largely because I enjoy the heck out of it, but also because I believe there's a real need for the information. Believe it or not, the Social Security program, now a little over 86 years old. And each and every month, Social Security pays about $92 billion in benefits to about 65 million people. And on top of that, there's another 176 million folks like you in the webinar who are out there working and paying into the program. And what I saw during my time at the agency, and now that I'm on my own, is despite the age of the program, despite the size of the program, frankly, despite the economic impact the Social Security has in this country today, unfortunately, as the title slide shows, the myths and misunderstandings that are out there about what the program is, as well as what it isn't, are frankly staggering. Nobody knows nothing about the program. So I was excited to accept Sarin's invitation to spend the next 7 or 8 hours with you, dispelling those. Oh, all right. Won't spend that much time. I promise I'll be out of here in time to watch the Red Sox game at 7:10. Spend a little time, talk about some of the things I think it's important for you to know about what the program is, and perhaps equally importantly, what it isn't. And why it's so important these days, 2 words, baby boomers. 75 million of us storming towards retirement, starting to wake up to the fact the retirement world staring us in the face is different. We're in the retirement world that faced our parents and our grandparents, starting to recognize that the Social Security program as a guaranteed stream of lifetime income may well be a bigger part of our retirement income than we had originally anticipated. We're also recognizing, well, maybe we don't know as much about the program as we should, and we're struggling to catch up. So tonight, I want to give you some good, solid information, again, to help you understand what the program is, recognize what it isn't, dispel those myths and misunderstandings that are so prevalent, set you down the road to the comfortable retirement everybody hopes to enjoy. The most important slide in the presentation is going to be this one. You'll hear me reference it over and over again. People need to recognize that when Social Security was created back in 1935, the program was put in place simply to provide folks with a base or a foundation of income that they can count on being there for them, but it's a base of income that must be supplemented because it was never intended to be anyone's sole source of income in retirement. But unfortunately, these days, about 21% of retiree couple households, the Social Security money comes into them each month is virtually the only income they have. Terrible situation. So how do you avoid that happening to you? Well, simple, by planning for your retirement. And you'd be commended, taking time out of your busy schedule, spending a little time with us this evening, learning about Social Security and planning for this aspect of retirement. Now, as you may recall, the Social Security Administration tried to play in the past a more proactive role in helping you plan for your retirement. Because back in the day, they used to mail you a paper document each year, a Social Security statement. Started going out back in 1999. The original distribution plan had those going to anyone 25 years of age or older who had ever paid into the program and who was not yet collecting Social Security benefits. That Social Security statement provided retirement planning information, benefit estimates at 3 ages, 62, your full retirement age of 70. We'll talk in a second why those are important ages. The other thing the statement did that was so important, it provided you with a year-by-year breakout of what the Social Security Administration had recorded as your work under the program. We'll see in a little bit that what you eventually collect is directly related to what your work and earnings have been. So if a mistake had occurred in crediting you with some earnings, it was important to catch it and correct it, because if you didn't, have a direct impact on what you eventually received. But you may have noticed, hey, I haven't gotten one of those every year lately. What's the deal? Well, Social Security has significantly altered its distribution plans for Social Security statements. And the big news is they no longer mail paper documents to everyone 25 years of age or older. Instead, what they've done first and foremost is put in place a system whereby if you go to www.socialsecurity.gov/myaccount, take about 15 minutes or so to set up an individual My Social Security account for yourself. An important byproduct of having that account in place is you'll be able to download through a secure website a Social Security statement whenever you need one or want one. I'm going to meet with Seren, do some retirement planning, being able to bring a current Social Security statement to that meeting, going to make it a more worthwhile exercise. So homework assignment for me, if you haven't yet set up your individual My Social Security account, I encourage you to do so. Once you start to collect, a lot of advantages flow from that account, but prior to collecting, the big one is you'll be able to download a Social Security statement whenever you need one or want one. By the way, Social Security has decided they'll resume mailing paper documents, but only to people who are 60 years of age or older and have not yet set up a My Social Security account. If you're under the age of 60, the only way you get a My Social Security statement is by setting up your My Social Security account. So take advantage of that planning tool designed to help you recognize the programs intended to provide you this base, this foundation of income, but it was never intended to be your only source of income in retirement. You need to take steps, find ways to supplement it. And the sooner you do that, the more likely you are to have that comfortable retirement. So let's talk about Social Security retirement benefits. And as I travel around the country and talk to people these days, wait a minute, who am I kidding? I'm locked away here in splendid isolation at the world headquarters of Czarnowski Consulting these days. But believe me, I did used to travel around the country and talk to people about retirement. And during those days, I think the most frequently asked question had to be, well, when should I take my money? So understand this, under the rules of the program, you have choices and you have options. What I'm trying to do this evening is make sure you fully understand what those choices and options are. In other words, I want to make sure you understand what you can do under the program. But ultimately deciding what you should do, that's your choice, your decision. After all, you're the ones who worked and paid into the program. I can't tell you what you should do. But my view is, unless and until you fully understand what you can do, you're in no position to decide what you should do. So let's make sure you understand the choices and options that are available to you. And the place to start is by making sure you know what Social Security calls your full retirement age. Key concept of the program. Now, when Social Security started back in 1935, Congress set full retirement age of the month you turned age 65. It was age 65 for everyone without exception. And in fact, continued that way till 1983 when Congress changed the law and increase this concept of full retirement age for anyone born 1938 or later. Now, this change has been gradually phased in over the past 20 plus years or so. And for a big chunk of the baby boomers, any of us who were born between 1943 and 1954, our Social Security full retirement age was the month we turned age 66. But it's important to note, it continues to increase. And under current law, tops out anyone born 1960 or later has a Social Security full retirement age as the month you turn age 67. Now understand this, collecting at your full retirement age month, it isn't your only choice, it isn't your only option. But make sure you know what your full retirement age month is based on your birth, because you'll see a lot of features of the program do flow from at least having reached your Social Security full retirement age. But you have to start collecting the month you hit your full retirement age. That means one thing and one thing only. It means you'll receive 100% of the amount your work and earnings entitled you to collect. That's what full retirement age collection means. But among the options you have are to start prior to reaching your full retirement age, if that makes sense for you. And under the rules today, you can start to collect as early as the month you turn age 62, if you choose to do so, or at any point in between, by the way. But here's the thing, Social Security, as the name implies, is a social insurance program. And Congress has built certain social goals into it. And one is the hope that at the end of the day, based on average life expectancy, everyone ends up with roughly the same amount of total lifetime benefits, regardless of when he or she started to collect them. And so you have to start prior to reaching your full retirement age. Well, then, because by starting sooner, in theory anyway, you'll now be collecting for a longer period of time, you're going to find your monthly payment amount gets reduced. How much of a reduction? Well, it's roughly 0.5% per month for each month prior to your full retirement age that you collect benefits. 0.5% per month, roughly a 6% per year reduction by starting early, but you don't have to start right on your birthday. You don't have to start the first of the calendar year, whatever point makes the most sense, but recognize that if you opt to start collecting prior to reaching your full retirement age month, you're going to receive a reduced amount. And oh yeah, it's a permanent reduction. Now, one of those myths that are out there, too many folks mistakenly think, yeah, I know, I'll start early, I'll get less, but as soon as I hit my full retirement age, my payment will bump back up. Permanent reduction. Again, the idea being you're starting sooner. So in theory, collecting for a longer period of time based on average life expectancy. So you're given less on an individual monthly basis. As I mentioned, full retirement age, you get 100% of your benefit, but you have to wait past your full retirement age before starting. Well, that's an option available to you as well. And now with that social insurance idea in place, if you think about it, if you've opted to defer a bit, well, now by starting later, in theory anyway, you'll be collecting for a shorter period of time. So by all rights, your monthly amount ought to be increased if you wait. And it is. These are referred to as delayed retirement credits. And for each month past your full retirement age, you opt not to collect, you'll now see that full retirement age benefit amount increase by 0.2% 2/3% per month. That translates into an 8% per year increase by waiting. But again, you don't have to not collect for a full year. For each month past your full retirement age, your benefit that you don't collect, your benefit permanently increased by that 2/3%. But here's the key thing. Delayed retirement credits only accrue from your full retirement age month until the month you turn age 70. Now understand this, under the rules of the program, you never have to take your Social Security benefits. Not like there's a required minimum distribution or anything like that, like there is with your 401k or 403b or IRA. But as far as Social Security goes, if you opt to defer from your full retirement age until age 70, you'll see your payment permanently increase by 2/3% for each month you haven't collected. You opt to wait past age 70 before starting. It's your right to do so, but you're not going to see any additional increase by having waited. So let me give you an example to illustrate what I'm talking about. We get somebody here with a full retirement age of 67. And let's say at her full retirement age of 67, she'd receive $1,000 a month. What are the options available to her? Well, under the rules, she can start to collect as early as the month she turns age 62. And though by starting at 62, she's collecting 5 years prior to her full retirement age. So the way the reduction factor works out, she'll receive 70% of that full retirement age amount. In other words, she won't receive $1,000 a month. No, she'll get $700 per month and continuing. Well, yeah, she's getting $300 less each month than she'd receive if she waited, but the trade-off obviously receives that lower amount sooner, and then in theory anyway, collects it for a longer period of time. She starts at 64, she gets a higher amount, she gets $800 a month at her full retirement age of 67. That's when she gets the full $1,000 that her work and earnings entitle her to collect. And so she wants to wait 1 year, start at age 68. Well, payment will be 8% higher by having waited that year, meaning the benefit, $1,080 per month and continuing. And she waits all the way until age 70. You'll see her payment increase by 8% now for each of those 3 years she's deferred. And it's simple interest, not compounded. But it means her benefit at age 70, not $1,000 a month. No, it's $1,240 per month and continuing. Let's say she wants to start at age 72. So it'll be that same $1,240, right? Because no additional delayed retirement credits past the month you turn age 70. Bottom line, as I said up front, your choice, your decision. What are the things you ought to be thinking about? You know as well as I do. Your health, for one, huh? Longevity, for a second factor. I always like to ask, do you come from a family of long livers? Or do you come from a family of short pancreases? Bum. Line out of the movie Goodbye Columbus 50-something years ago. I can't take credit for it. You need the money. You're going to keep working. All those factors have been in play. The whole idea always used to be based on average life expectancy. It was all supposed to come out about even. But you know what? Life expectancy is increasing. Social Security numbers say 65-year-old man today, on average, you're going to live to age 84. 65-year-old woman, on average, to age 86. But even more telling to me, Social Security numbers say of today's 65-year-olds, 1 in 3 expected to live to age 90, 1 in 7 age 95. We baby boomers and those that come after us need to recognize, because life expectancy is increasing, retirement for us could be a period of 20, 30, or maybe even more years in length. And as a result, my personal view is that because for most of us, as we head into retirement these days, if we have any type of pension at all, it's far more likely to be the defined contribution type, right? 401k, 403b, 457. We're walking out the door, not with a guaranteed stream of lifetime income like you used to get with that traditional defined benefit pension. No, we're walking out the door with a pile of money. So it seems likely to me that later in retirement, that pile of money will have diminished somewhat. Later in retirement, healthcare costs may be higher. So you may have a greater need for a higher monthly income later in retirement than when you make that initial transition. And one way you can partially meet that need is by delaying the start of your Social Security benefits. But again, it's not for me to say. It's your choice, your decision. I just want to make sure you're making an informed decision. And in the simplest form, you start sooner, you get a lower amount for the rest of your life. You wait longer before you start, you get a higher amount for the rest of your life. But the key thing to me is, when Congress set the reduction rate and increase rates so many years ago, based on average life expectancy at the time, yeah, it was all supposed to come out about even. But these days, because life expectancy is increasing, I tend to think that good things come to those who wait. But again, not for me to say, your choice, your decision. I just want you to be making an informed decision. So second area I always get questions about was, well, how do they figure out how much I'm getting anyway? As I mentioned earlier, there's a relationship between your work and your earnings and what you eventually collect. But we'll see in a second, it's not a perfect correlation. But in calculating benefits, Social Security simply uses a formula that Congress has written right into the law. Formulas in a number of different steps. First step is Social Security does adjust all of your prior year earnings for inflation. Bring them up to what they are in today's dollars. But then once they've done that, they calculate your benefit by plucking out and averaging, wait for it, your highest 35 years of work under the system. Another one of those myths that are out there. Too many folks mistakenly think it's my high 3, right? Or my last 5, like some other pension systems. Social Security benefits calculated by averaging a lifetime of earnings, with these days defined as your highest 35 years of inflation-adjusted work under the system. So what happens if you don't happen to have 35 years where you've actually paid into Social Security? You've taken time out of the workforce to raise kids, care for aging parents, or perhaps work for a while in a job where you weren't paying into Social Security. Unfortunately, no provision for that. It's still going to be an average of your 35 highest years. And if you don't happen to have 35 years of something, zeros get added in for those additional years. It lowers your average monthly wage and it lowers your benefit. Here's the takeaway for tonight. Another reminder about Social Security being that social insurance program I referenced, and putting that formula in place. Congress has recognized that people in lower paying jobs, less likely to have a pension, less likely to be able to save for retirement. So the formula does try and help people in lower paying jobs by providing a monthly payment, which is intended to replace a higher percentage of earnings for someone who's at the low end of the scale. Now, for somebody who's been a higher earner throughout his or her working years, by all means, he or she receives more each month in absolute terms than the low earner does. But if you look what the payment represents, it's actually designed to replace a smaller percentage of that person's pre-retirement income, somewhere in the neighborhood of 34%. And for the average worker these days, the Social Security payment only intended to replace around 41% of what someone's making at retirement. In no case, low earner, high earner, or average earner, is a Social Security payment intended to replace 100% of what somebody's making, which leads us back to that first slide I showed you. Got to recognize programs designed to provide you a base or a foundation of income that you can count on being there for you, but it's a base of income you must take steps to supplement. And the sooner you recognize that, work with Sarin to move from what Social Security provides to where you need and want to be, the more likely you are to have that comfortable retirement we hope to enjoy. Let me give you a couple of numbers to chew on this evening. In the year 2021, the average Social Security retirement benefit being paid is $1,543 per month. $1,543, which translates into $18,516 per year. Then I often get asked, well, is there a maximum payment that Social Security makes? Well, in the year 2021, for someone who is at his or her full retirement age this year, which is 66 years and 2 months, and who for each of the past 35 years has had earnings at or above the Social Security taxable maximum. That's an important point. Each year, there's a maximum level of earnings upon which Social Security tax is imposed. 2021, for example, you could make $500,000, but you're only going to pay Social Security tax this year in the first $142,800 that you make. So when it comes time to average your earnings to calculate your benefit, Social Security doesn't average in that $500,000. No, they only average in that $142,800, only earnings that have been subject to Social Security tax. So again, to recap, 2021, someone at his or her full retirement age of 66 years and 2 months, and who for each of the past 35 years has had earnings at or above the taxable maximum for each of those years. This year, he or she receives, drum roll, please, $3,148 per month, $3,148 per month, or $37,776 per month. Nothing to sneeze at, but again, it's a base, it's a foundation designed to provide you that base that you must take steps to supplement, because it was never intended to be your only source of income in retirement. By the way, if I had been given the full 8 hours I was originally promised, we'd be going through this in excruciatingly painful detail. But you want to learn more about benefit calculations and computations? I want to direct you to Social Security's website, www.socialsecurity.gov/OACT, which is an abbreviation for the Social Security Administration's Office of the Actuary. They've got a great deal of information. You all know what an actuary is, right? An actuary is somebody who doesn't have enough personality to be an accountant. Ba-dum-bum. All right, let's keep moving on. Try and do this. Where's my clicker? So the next area I want to talk about is working in retirement. Another area I get lots of questions about, and another area where it's vitally important to know what your Social Security full retirement age is. Because of the rules, if you are under your full retirement age, looking to collect benefit payments, but intending to work at the same time, you need to understand you're limited in how much you can earn before it begins to impact your ability to collect. In the year 2021, if you are under your full retirement age, looking to collect Social Security benefit payments, but intending to work, need to understand that you're allowed to make up to $18,960 without any loss of benefit payments whatsoever. You make $18,960 or less, you can collect full Social Security payments every month of the year. Now, you make above that doesn't mean you can't necessarily collect, but Social Security is required to start holding back $1 in benefits for every $2 that you're over the threshold. So depending on how much you're making, you may not be able to collect even if you want to. So what counts towards that $18,960? It's earned income only, wages and or net income from self-employment. That whole wide world of unearned income you might be receiving, a VA benefit, 401k distributions, bank interest, dividends, none of that counts towards that $18,960 threshold. Earned income only. The great news is from the month you reach your full retirement age on, there's no longer any earnings limitation imposed whatsoever. And from the month you hit your full retirement age on, you can work and earn as much as you'd like and collect full Social Security benefit payments at the same time. I don't know how many times I've been asked the question, hey, I'm retired collecting benefits, but I'm thinking about going back to work. I don't have to pay Social Security tax on my earnings, do I? Well, if you're in a job covered by Social Security, yes, you will, which is good news for the good folks at Social Security because they can certainly use the money these days. But there's potentially good news for you. I mentioned your benefits always calculated by averaging your 35 highest years of inflation-adjusted earnings. And it's your high 35, regardless of when they occur. It isn't necessarily your first 35. It isn't necessarily your last 35. It isn't even necessarily 35 consecutive years. So even if you're retired, you go back to work, pay into the system at the end of the year, you file your tax return. Social Security is going to do a match. Excuse me. And they'll compare that new year of earnings with the lowest of the 35 years that they had been averaging to calculate your benefit. And if your new year is higher than the lowest of the 35, the great news is they drop out the low year, plug in the new year, and it results in a benefit increase for you. And this ability to increase your payment through additional work, it continues forever. Delayed retirement credits, yeah, that bump because you haven't collected, those stop when you turn age 70. But no matter how old you are, if you're working, paying into the system, and your earnings are higher than the lowest of the 35 years that Social Security had been using to calculate your benefit, well, the great news for you is, end of the year, you're going to see a payment increase as a result of those additional earnings. And the other bit of good news, frankly, about working, it really never hurts. So you've been a high-priced executive, but in retirement, take part-time job at the Oakley Country Club, driving the beer cart around. Well, at the end of the year, that beer cart, $2,000 or so in earnings, probably going to be lower than the lowest of your 35 years. So what happens to your payment amount going forward? Nothing. Stays the same. It's always based on an average of your high 35. So I said earlier on, I think good things come to those who wait. I think good things can come to those who work as well. Because as long as you're working, paying into the system, there's always the possibility those additional earnings are going to increase your benefit for the rest of your life, and they're never going to reduce it. So I want to spend a couple of minutes talking about Social Security spousal benefits and then Social Security survivor benefits. Now, in the recent past, probably 20 years or so, there are a whole large number of Social Security claiming strategies that were all the rage. There were ways that couples could coordinate their benefit collection in order to optimize or maximize their lifetime Social Security benefits. Now, you may have heard of some of these strategies. File and suspend. Claim some now, claim more later. File a restricted application. All of those were out there, and as I said, they were all the rage, and they were a way that couples could optimize or maximize their lifetime Social Security benefits. And they were really great deals. In fact, they were such great deals that Congress decided to eliminate them with passage of something called the Bipartisan Budget Bill of 2015 at the end of 2015. And so all of those claiming strategies have now been nearly completely eliminated. And so in terms of spousal benefits, we're back to the basics, to the fundamentals, back to basic blocking and tackling in football parlance. And the spousal benefit program operates in the following way. These days, you go to Social Security looking to collect a spousal benefit, you're always required to take your own retirement benefit first. And then Social Security, if your spouse is collecting, Social Security will compare your full retirement age amount with 50% of your spouse's full retirement age amount. And if your own full retirement age amount is more than 50% of your spouse's, well, then you don't get any type of spousal benefit. You collect solely based on your own work record. But if your own benefit, full retirement age amount, is less than 50% of your spouse's full retirement age amount, well, you collect your own, and then you get some additional money to bring you up to that 50%. Now, the key thing is that spousal payment, paid in addition to whatever's paid to the spouse, doesn't lower anyone's payment. And the important part is, again, you always collect your own retirement benefit first. Earliest age you can collect a spousal payment, age 62. Same as on the retirement program. If you're at your full retirement age when you apply, you get the full 50%. You're under your full retirement age, well, that benefit amount gets reduced, again, because you're claiming it early. Now, as far as divorce spousal benefits go, with regular spousal benefits, you simply need to have been married for 1 year. With divorce spousal benefits, marriage needs to have lasted 10 years prior to the divorce. Now, with regular spousal benefits, as I mentioned, you can only collect if your spouse, get that spousal portion, if your spouse is actually collecting. The law says in case of divorce, as long as both of individuals are 62 or older, and the divorce was finalized at least 2 years ago, that divorced spouse can collect as if, even if the other member has not yet started to collect. And the third requirement, though, for divorce spousal benefits is you cannot be married. If you're married, you lose eligibility on your ex, although after a year, you gain it on your current spouse. And with those conditions being met, it's the same basic test. You collect your own first. If it's more than 50% of your ex's, that's all you get. If it's less, you get your own plus some additional money. What about survivor benefits? Well, here the news is a little bit better, because now the comparison is not between your own and 50%, but it's comparison between your own and 100% of what your deceased spouse was collecting. Again, you collect one amount to the other, whichever one is higher, you don't get both at once. With survivor benefits, you can collect as early as age 60, but the same concept holds. You're taking that payment prior to reaching your full retirement age, you get a reduced amount. And it works out, you start at the earliest point, right at age 60, you get 71.5% of the amount you'd receive if you waited all the way until your full retirement age to claim the survivor benefit. Now, again, you collect on one amount or the other, whichever one is higher, you never get both at once, but it is possible under the program rules for a widow, for example, or widower, because the program is gender neutral, to collect a reduced survivor benefit, starting, say, at age 60, collect, and then at full retirement age or earlier, if they chose to, switch over and begin to receive a benefit based on the person's own work record. And the reverse could be true. But again, you collect on one or the other at a time, but it is possible to sequence the collection. But keep this in mind, whether you're talking about a retirement benefit, a spousal benefit, a divorce spousal benefit, or a survivor benefit. While you're under your full retirement age and working, you're going to be subject to that earnings limitation I had mentioned a couple of slides ago. So a widow at age 60, working, making $1 million a year, not going to be able to collect at that point. Not because she's not a widow, not because she's not age 60 or older, but because she's subject to that earnings limitation. So just keep this in mind. Important part of the Social Security benefit package is that survivor benefit program. Quick reminder about taxation of benefits. Prior to 1983, Social Security benefits completely federal tax-free. That your Congress changed the IRS code, said if you're a higher income Social Security beneficiary, you'd be required to start paying federal income tax on a portion of the payments that you had received. Back in 1983, they defined a higher income single Social Security tax filer as someone who made $25,000 or more in income from all sources, couple filing jointly, $32,000 or more from all sources. And here we are, nearly 30 years later, those thresholds haven't changed. So at the end of the year, if you're a single tax filer, you have income from all sources in excess of $25,000, couple filing jointly, income in excess of $32,000, again, from all sources, you'll now find yourself, though, in a position of having to pay federal income tax on up to 85% of the payments that you had received in the prior year. 15%, what you receive, always federal tax-free, but up to 85% treated as ordinary income taxed at whatever marginal tax rate you happen to fall under. These days, about half of the folks who receive Social Security benefits do pay federal income tax on a portion of their payments. At the end of the year, Social Security sends you a 1099 form. Use that in filing your tax return. The question often comes up, well, does Social Security automatically withhold a portion of my benefit payments and send it off the IRS in advance like they do for my salary? The answer is no, they don't do it automatically. But if you'd like to have it done at your request, they will withhold a portion of your benefits, send it off in advance, and maybe avoid the need of your filing quarterly estimates. Taxation of benefits. By the way, this is federal tax rules, which applies across the country in terms of state tax of Social Security benefits. Well, the vast majority of states, 37 out of the 50 states, do not tax Social Security benefits in any way, shape, or fashion, including here in the Commonwealth of Massachusetts. That does leave 13 states around the country that do tax Social Security benefits in some form or fashion at the state level. So depending on where you end up in retirement, just be aware, if you're in one of those 13 states, you'll pay state income tax on a portion of your benefits. Taxation of benefits, just something you need to plan for. All right, so you've reached the end of your rope. You've had enough. You've decided I'm retiring at the end of the calendar year. What do I do? Well, Social Security can accept an application for benefits a maximum of 3 months in advance of the month you want to start to collect. So you decide you want to start to collect effective with the month of January of 2022. That means you can apply for benefits at any point after October 1st of 2021. And how do you apply? Well, for me anyway, the simplest, easiest way is Social Security's online retirement application. Take you about 20 minutes or so from the comfort of convenience of your own home, day or night, stopping and starting, wearing your pink footy pajamas for all anybody knows. But if you're not comfortable filing online, and oh yeah, by the way, to use the online application, you do need to have established a My Social Security account for yourself in advance. So another reason to do it now. But if you're not comfortable dealing online, you can call Social Security, set up an appointment for a telephone interview. They'll call you at the appointed hour and complete the application with you over the phone. And at some point down the road, post-COVID, local offices will again open to members of the public. You'll be able to call and make an appointment for a face-to-face interview at a local office. But at this point anyway, local offices are closed. Now, just a quick reminder, Social Security benefits go out 1 month in arrears, meaning you decide you want to start to collect effective with the month of January of 2022. You're going to see that January payment sent to your bank account in February. The January payment sent to you in February. Social Security payments are also staggered through the course of the month. If anyone's birthday is between the 1st and the 10th of the month in which you're born, your payment always direct deposited into your bank account on the 2nd Wednesday of the month, regardless of the date. Birth date falls between the 11th and the 20th of the month in which you're born, payment always direct deposited on the 3rd Wednesday of the month. And if your birth date falls between the 21st and the end of the month in which you were born, payment always direct deposited on the 4th Wednesday of the month. So you're retiring December 31st, but your birthday 28th of the month, whatever you were born, just recognize your January Social Security payment won't be received until the 4th Wednesday of February. So just something you need to plan for, because there is this lag in benefit payments.